Hello, ladies and gentlemen. Well, I still don't think that the risk dial can tell us anything of consequence at the moment. It's basically saying that the spreads are neutral, not trending, or if they're trending, they're not trending very hard. And therefore, one should have a beta standard allocation to assets, i.e. be long of them, but not leveraged, and to be ready to anticipate some kind of reversal. It might or it might not come, and it will definitely come because of Fed action and ECB action, but until we've seen those, we really can't decide which way to jump at the moment. So what have we had this week? Well, we've had the NFP, and next week we have the last of the data that Wallace said he is looking at, i.e. CPI and PPI, and the week after that we have retail sales, which is the last data point that he will decide upon whether he wants to cut or not. And I expect that most of the FOMC participants and voters are exactly in the same boat as Waller. So this is the last really few data points that they are looking at to decide what happens and how the yield curve will react. My personal favorite is that they cut, because they hate to disappoint the market, but they cut in a very hawkish way, i.e. they say that this is it until the data then justifies further action in either direction. Last week we couldn't flatten, so we steepened a tiny bit. I mean, a couple of basis points, 3 basis points or so, which was my expected reaction. I don't think that we can go and now flatten before the FOMC. I just don't think the data is going to allow it for the time being. But do we steepen a lot? No, absolutely not. I will be getting out of whatever I have around this 27 area, which is only another 4 basis points in 230s. I think that we are going to just meander about before the Fed, and let's have a look at what I think is likely to happen and what the market reactions can be. I think the Fed is split into 2 camps. You have the doves, and they think that the current rates are very restrictive, and they would like to get them to, I don't know, 3% or something like that. They think that is neutral. I firmly disagree with them. I think that the neutral rate is far closer to 4 at the moment than it is to 3. But, my opinion doesn't count. It's their opinion that counts. And the other side of the FOMC, you have people like Bauman, who, and she is, I think, correct, who say that the neutral rate is rising all the time and it is far higher than the models say it is. What can be some kind of a compromise between them so that everyone votes in unison? Well, it could very well be that they decide on one more cut in December. But the problem is that if there is a cut in December, everyone or the market will start anticipating another cut in January, and the whole market will start going through the levels that the Fed might be comfortable with. So if we have a look at what is happening at the very short end, you see that the 3-month is making new lows. If they were to cut and not do a hawkish cut, this level would go far lower. Much the same as in the 1 year, the 1 year would go down to at least this kind of level, 4%, if they don't do a hawkish cut and look to go further. The 2 year would go below 4%, but not by a lot. I would have thought 395 or something like that. But still be looking for further cuts, as the Fed has not told you that the terminal rate is not going to be below, say, 3.5%. So what do they need to do to basically bring together the two opposing sides, the doves and the hawks? I would have thought that the easiest thing to do is to come out with one cut in December, but say that this is the last cut until the data justifies more action by the Fed in either direction. So they would leave it open to the market to decide what the appropriate level of interest rate should be and what the yield curve should look like. That to me would be a natural flattener. So let's have a look at 2s, 10s and see the opposing reactions we should have from the yield curve according to what the Fed does. If my hunch, and it's no more than that, and therefore I'm not going to be positioned for it, is correct that they come out with a very hawkish cut and that they say, and they, in the presser, they really have to stress very hard that this is the last cut until the data supports more or hikes, whichever way it goes, then you are going to have the situation in which 2s, which yielding 4.10, and don't forget now you're going to have the Fed funds rate, effective Fed funds around 4.30, right? So the lower corridor is 4.25, so it's 4.30, 4.32 effective Fed funds rate. The market will immediately stop looking for another cut in January and only look at cuts every other 2 or 3 meetings with a terminal rate somewhere around 350, 375. That would be my immediate guess at the first reaction, in which case 2s don't go very far, but there'll be no pressure on them to go lower. So they would trade 4.20, while the long end would definitely get bought because, as you can see here, the 20s and the 30s would have positive carry for the first time since God was a boy. If they get positive carry and the Fed is basically tightening the current financial conditions because the market is expecting further cuts and it's saying you're not going to get as many as you are expecting, or what you have priced in is about right, i.e. a terminal rate of around 375, then I think people will start buying more duration because they are going to feel satisfied that the Fed is not being reckless and is not going to lower rates too far. And don't forget, we still have a real rate which is approximating 2%. That, for a few months, I think is going to look very attractive to people unless the economy naturally starts accelerating again. But I don't see why it would, not immediately for sure. And therefore, I would have thought that people would extend duration. They would say, why own 2 years at around 4% and 30 basis points below funds when all I'm really looking for is another 50 basis points of easing over the course of a whole year? Why not extend duration and go up to 10s and 30s, but, the longer end? And to me, that would be a natural flattener. On the other hand, if they don't do that, if they just cut and they say, well, it's okay, things, R star is who knows where it is, but it's probably a lot lower, then the market will just, look for further cuts in January, regardless of what the S&P dot plots say. The S&P dot plots are likely to be higher, and they have to be higher because everything that they're based on is higher than the last time they produced them. So we all know they're going to be higher. The market is going to say, okay, so you cut, and it's not a hawkish cut, it's just a normal cut. Therefore, you think rates are, terminal rates are quite a bit lower. So what are we going to do? Well, we're going to keep on buying, twos. Why not? We're going to keep on buying twos and fives. That's where the bang for your buck is. Very soon we're going to have positive carry on those as well. So we'll keep on buying it. And therefore, the yield curve, what can it possibly do? Well, it's certainly not going to flatten a lot. It's probably going to steepen, because the long end is going to start thinking that the Fed is being reckless. Every data point that they base SEPs on is higher than they expected it to be last time they produced them. So I would not be surprised then if we get another wave of steepening and we go to somewhere around here, 30 basis points or even lower in the 2s, 10s, if that were the case. The long end will not like a cut which isn't hawkish in any way. So to me, before the Fed, you get out of the steepeners and wait to see what kind of a cut it is, because the market is pricing an 88% probability of a cut. If they don't cut, I think that's very good for the long end. And then you really do get quite a bit of a flattener, and it might even go up towards the 200-day moving average at 16 on the 2s, 10s. That would not surprise me, but from that level we'd be looking to steepen again. But to me, it's absolutely certain that if the Fed cuts without any kind of warning to the market that that is it, boys, until we get data justifying anything further, whichever way, the market will take that not well, i.e. the market will steepen and all these bond yields are going to go higher. So to summarize, no cut, which would be a bit of a shock. And I'm looking now at 10s and 30s, we're going to do much the same thing in parallel, as it were. If the first reaction is higher yields, which probably should be, it's a buy. If it's a cut, but it's not hawkish, it's a sell. And I would have thought that on a cut, we go down towards the 4% area, but you get out of there and you do a steepener. If it's a hawkish cut, like I've said, that my gut tells me it could very easily be, then you actually sell the 2-year, which is going to be somewhere, around here, I would have thought, 394 or something like that on the cut, and you get rid of anything in the short end for the time being, because it's just not worth having. If the terminal rate is going to be completely determined by the data, it certainly isn't going to be very low. It's going to be around 3.75 to 4%. So why hold the 2-year down here? That would make no sense. You would much rather hold something with currently positive carry, which will be something like the 10s and 30s. So to me, it's the only thing that makes any sense, that on a cut, the yield curve first of all steepens, but then on the presser, if I'm correct and it's a hawkish cut, it reverses. And you do not want to be long of the short end on a hawkish cut. You want to be long of the reaction in the long end. We also have the ECB, and the market is pricing slightly more than a 25 basis point cut by the ECB. I don't think the market is going to get it. I think they're going to cut 25, but they're going to remain dovish. To me, any kind of move up here in 210 to 215 in the Schatz is a buy. I'm not going to argue with Schatz up there. Where I would argue is Schatz down here, because that didn't make any sense ahead of a potential only 25. But what I do like is if the market is disappointed and the Bund goes back up towards 220, to me that is going to be a decent level to buy it. It's the same argument as for the US. The less the central bank does, the more it's bullish for the longer duration. I think that that makes perfect sense to me. If the market is disappointed by what the ECB does, this 222 level is going to be an excellent level to get long of bunds, because the less the ECB does now and the more hawkish they are now, the more the economy will not recover fast, and therefore the more you want to be at the longer end rather than the shorter end. The market's reaction to the alleviation of the crisis in France is actually very interesting, and this is Italy against Germany. They bought Italy. They haven't really bought France. If you have a look, this is the spread Germany-France, and it's just going back to within the range that it was. This chart still looks rubbish. It still looks like it will break down at some point, right? So to me, France is just not investable at the moment, certainly not at 75 basis points pickup. But what is interesting is that they bought Italy, because the thinking goes like this, I guess. Right, no more crisis or alleviation of crisis. I want a pickup. I want a pickup over bunds, and the pickup comes from Italy, Spain, who knows where else. And where are we going to? Well, I guess down to 95. That level seems to be the preferred level since 2021, where you can have the Italian BTP over the Bund in a time of complete stability. And that makes sense to me. You want to pick up, and you've always wanted to pick up. If there is no political turmoil in the EU, you go for the peripherals, which offer you the pickup. But we're getting to levels where it no longer makes sense. I'd be very, very wary of owning BTPs sub 100 on the spread. All week last week, the spreads between Germany and the US came in, which is good. I think that anything around this kind of level, 201, is a pickup, and I think you want to be buying shats, because I don't think that we can go down much more. And in tens, you are looking for this kind of level around 197, 198 for another retest higher towards the 220 level. I do prefer Europe to the US. I won't prefer it if we get a hawkish cut from the Fed, but that is, 10 days away, as opposed to the ECB, which is going to be this week. So if you get a dip down here, you definitely want to be a buyer of Schatz and the Bund, but preferably the Bund. I think that that makes far more sense. Given that the spreads between the US and Germany did what they did last week, it's no surprise that the Dixie couldn't make any headway. It really closed pretty much unchanged on the week, which is a bit surprising. I would have thought it'd be slightly weaker. But I think that my support and resistance levels, what do I have, 105.50-ish and 105, are going to definitely hold. These levels are going to be very good levels to buy the Dixie, and also they are triangulating against my levels to buy bunds as opposed to 10-year notes. And certainly I think that if there is a negative reaction in bunds to the ECB cut, you have to buy it, and you triangulate it against the dollar, the Dixie here, not doing very much. So to me, the Dixie at worst tests this 105, and at best it starts going back up towards 107. I don't think that the move in the dollar is over. I think that we have one more high to around the 109.30, but that I think is going to happen sometime probably next year. Triangulating that against Euro USD, if I see this kind of level, 106.50 to 106.80, I am buying puts and some puts, and then if the Fed does a hawkish cut, then I'm buying a whole load of puts, because that will be the signal that the Euro USD will actually go and make new lows here below 104. And I would have thought that if the hawkish cut, we go straight towards parity, and we are at 109, 110 in the Dixie. Not immediately, but over the course of, say, a month or so. That will cement the differential between the big wide differential between the US rates and German rates and EU rates in general, and will actually allow over time Euro USD to go and test the parity level. What about gold? Well, who the hell knows? But this to me does not look bullish. This to me looks like he wants to test the 200-day moving average down around the 2500 area. I have no idea why it would do that, because I am bullish on duration if the Fed does a hawkish cut, and I'm not otherwise. But one of the reasons could be the strong dollar. If there is a hawkish cut, you get a strong dollar. People extend duration, which doesn't mean that duration rallies a huge amount, but it just means the yield curve flips and goes and flattens, and that could be enough to push it down towards the 200-day moving average. I'm not in love with gold. I still think it's rich. It's rich to everything I look at, and I much prefer real yields, but I've been wrong all year, so don't listen to me kind of thing. I just don't see why you would want to have more than a normal allocation to gold still at these levels. I still think that you have to look for the 2500 level to have any kind of comfort in owning gold. The more I look at these commodity charts, the less I like them. And that's another triangulation point to my view, that you want to buy duration on a hawkish cut. Simply because I just don't see where this inflation is going to come from if all the commodities are in some kind of a downtrend. We still haven't turned the 200-day moving average in oil, but I think that we're very close to doing that. Another few weeks, trading this 75, 65 range, and this thing will start turning over. And if we look at copper, we get the same. We are trading below the 200-day and moving average and the 200-week moving average. They're still pointing upwards, telling me that we are unlikely to dump straight away, but we are not looking good for the longer term kind of thing. And if we look at DBC, which is an index of all of them, it looks exactly the same. We're just hovering around this 2175 area, where we basically started the year, and the whole year we've tried to go up, we've tried to go up, we've tried to go up, and we couldn't. And we are closing the year right towards the lows of the trading range for the year, which tells me maybe it's time to extend duration if the Fed is saying that they are going to let the market determine the terminal rate as opposed to them forcing the market lower. That is all that I can say about commodities. I'm keeping well away from them, but they keep on telling me that duration at the lows is not such a bad thing to buy. When will this Goldilocks end? Well, I think the only thing that we can say is that it will end when SPY TLT or ITOT over government is no longer trending upwards. If I am correct and duration will be a buy when the Fed does a hawkish cut, then how can I start being bearish of equities until we start turning ITOT over government or SPY over TLT? It just doesn't make any sense, right? So if bonds are going to start doing slightly better at the long end, that is actually supportive of equities. The only reason why equities would really come down is because SPY TLT is turning and people are preferring bonds to equities, and that is only going to happen once the data for the economy gets really, really weak. And that certainly I don't think is going to be in December. Given that, I just can't see why equities would have a nightmare over the course of the next couple of weeks. This is where we came up, the election result came up that night, November the 6th, and all we've basically done since is been in a very tight range in SPY TLT and not such a tight range in ITOT over government, which takes care of everything, every part of the yield curve and the totality of the stock market. So we are still trending up, and any dip is going to get bought. Certainly a dip down to 559 is going to get bought initially, because all you've done is fill the gap from the election night. I just can't see that these charts are foreshadowing any kind of weakness in equities, and that is why my allocation is a normal allocation and nothing special. To get bearish of equities, you have to get bearish of these risk indicators, and that at the moment just isn't likely. I just want to add that if we get a hawkish cut from the Fed, then I would start preferring TLT over SPY and looking for this gap to get filled. My rationale would be that equities have far less to look forward to than bonds, because if we have a Fed which says, right boys, that's it, and now the data has to get us to ease or to tighten, then people will like the duration or the rate of the bonds, but they might start getting disappointed in equity valuations, because what the Fed is effectively saying is that they are removing accommodation from the market, and they're instilling fear in equities, because they're saying the only way we are going to get any help from bonds is if the economy weakens. Well, if the economy weakens, it's not so great for stocks. So this chart then could start turning slowly, and sometime in the next 2 or 3 months we could start getting risk off if the economic data allows it. But it's not going to happen quickly. It's going to be a very, very long process of several months. The data would need to turn. So what I'm saying is that if we fill this gap, we certainly don't break this level, but this would allow for a decent downdraft in equities, which would get bought, and into the new year would be up here again. So I don't think that we've seen the highs in equities, and I don't think that we are in a dangerous, precarious position, because I quite like duration if the Fed does a hawkish cut. To me, a hawkish cut is long-term good for the economy, and it's long-term good for bond yields, and therefore it's long-term good for equities. We might get some short-term weakness, but until we start breaking this trend, and this trend is very, very clear, I just can't get short of equities. All I can do is have a normal allocation to them and not get too excited at the highest levels. But I'm still looking to buy a dip. I tweeted you on Friday that the 1 week straddle at the money was actually showing an expected range of less than 1% for next week. And really that is saying that we're not even going to test the first support. This is to me the first support, which is 6,003, maybe 6,025, 30, whatever you like to put it. I like to put my line at the highest close of these bars, and these are 195 minutes. I just like to do that. It makes sense to me. This wave topped out, highest close was that level. You know, we of course went a few ticks through it during the trading, but who cares? Now, that is basically saying, as I'm trying to explain, that we are not even going to test 6,003. 1% is what, 60.35, and so that is what the first support has to be, because that is what you're getting from the straddle. It's amazing that at these levels the straddle isn't implying even a 1% move for the week. We are very, very overbought if you look at it, but that basically just tells you that no one in the market, none of the big players, can really see a reason for equities to absolutely, have a big move for now. And I think I agree with them. I think that any dip more than the straddle is showing is going to get bought unless there's a very good fundamental reason. And the good fundamental reason can only be a very high CPI and PPI, a very, very hot one, which bonds absolutely hate, and duration gets sold to hell. But then still, the equities are going to get support because it's going to be an SPY TLT move higher, and therefore it's bonds they're going to sell, not equities. The equities will feel some downdraft, but all that's going to happen is that you're going to have support around the 6,000 level. So very difficult for me to get bearish, outright bearish of equities, until the data starts turning, and until SPY TLT or ITOT over government, whatever you like to look at, starts telling me that there is some kind of a risk-off brewing. There isn't, and we can play semantics until we're all blue in the face, but at the moment there is just no alternative to equity. You, as a beta player, you want to be long with them. As an alpha player, you want to buy the dip. That is what all the charts, and that is unfortunately what the fundamentals are saying too. The only time you'd want to reverse that opinion is if the Fed does something like I've suggested, and then it makes sense to start preferring bonds. But at the moment, until they've done it, having that position that way, it just doesn't make a lot of fundamental sense. The stocks is actually, to me, very interesting. I would love to see another retest of around the 48.50 area, and then for it to go up to 5100. It's not the market that you can buy until a monthly close above 5100. As you can see, that's 50.50 is the monthly highest close that we've had so far. We start closing above 5100, and this thing is going to go to the races. I have no idea why, but when you get a chart like this, the highest close, and this is the level going back to 1999, I believe, or maybe even 1998, and you start getting monthly closes above the all-time high, and you have a 25-year consolidation that is breaking, I find this very hard to short. And if I find it hard to short, I just, the only way it can go up, it can go really a long way, is up. And therefore, if that is the case, that tells me that why would I sell US equities? Volatility is also not giving any immediate warnings. If you see what the pattern is for volatility, it's that it does several weeks, and this is a weekly chart, it does several weeks at the bottom. Where is the bottom? It just never goes really below 1180. We closed right at the lows last week. This is not a pattern that tells me that we are about to break down in equities or there's any reason for panic. I would have thought several weeks of down at 1180 makes far more sense. Get people really, really long. And then in January you have some kind of a spike in vol which coincides with, the market stopping people out. It just doesn't seem likely to me that this month is the month that we have any kind of brutal action in equities that gets people stopped out. Could always change, but the only thing that would change it, I think, is Fed action or Fed inaction, which changes completely the shape of the yield curve, and that we won't know till next Wednesday or Thursday, and let's wait for it and react to it. We know what makes sense, and that is to buy duration if the Fed is hawkish, not in the sense that it doesn't cut, but in the sense that it finally tells the market that they're not going to cut further and not to expect further cuts unless the data changes. If that doesn't happen, then I think equities are just going to keep on running away. I've changed the levels, but I think the most important takeaway is to be patient here and let's see what the Fed does, and let's see first the CPI and PPI data. And if they're in line, I think all the markets are going to start pushing higher, both bonds and equities. So if they disappoint to the downside, PPI and CPI, you probably get quite a good move out of the 2-year, but I think anything below 405 in the 2-year is unsustainable until we have the Fed and we know what they're going to do. If they are hawkish, I think the yield curve will flatten quite a bit because the bonds have been waiting, the long end has been waiting for the Fed to be hawkish for quite some time. And if we finally get hawkishness, we start really flattening that yield curve, and I think we'll have a flat yield curve around the 425 area for quite some time. Let's see what happens. Let's be patient because you could make a lot of money if you get the yield curve move right. Thank you very much indeed, and tweet you tomorrow.